much for your attendance, for your interest in our fund. May I just give you a brief overview of the group, Liquidity, founded 1996, wealth manager and asset manager. We have roughly 7+ billion assets under management. Majority wealth management, 1.7 billion in asset management. What we do, in portfolio management, we do thematic funds which are trying to be out of the box, which are trying to be ahead of the curve. We have one, let's say, approach which means buy and care, not buy and hold, but buy and care. So we do very much engage also with the companies in terms of what we invest in. So we really want to see, we also want to drive the ESG component for one side. And on the other side, actually, I introduce you to the fund manager, Christian Rössing, who is the fund manager from the Electrification Transition Fund. We are amongst the team which has the most experience in the energy transition. So this is not a private equity fund, this is a listed long-only fund in the energy transition, which is a big theme that will drive us more than 20-30 years maybe from now on. It's very interesting what kind of propositions there are around. Christian will talk you through, and I would engage you please in all the presentation. If you have questions, please come with the questions on the spot or afterwards. We have half an hour presentation and then time for questions. Thank you very much. Let's go ahead. And the expectations I heard are high.
Oh,
very
good.
Okay, so AI is one of the topics. Okay.
Excellent. Well, I'll be there. So here myself, just as a quick introduction, Christian Rössing, working together with Andreas Schneller. Andreas, over 20 years managing one of the two funds, the infrastructure fund. Myself, also almost 20 years of experience in the thematic investment, especially on the environmental and energy side at Vontobel and Pictet, before now joining a year and a half now, Inesia, the Inesia team at the Pictet Cirettini. We have our CIO and two portfolio analysts in here. So let me dive right into it. So two funds, so just so that you have the picture here. We have the infrastructure funds. This is a 100% utilities fund, listed infrastructure if you want, looking at investing in utilities, so stable cash flows, very defensive, but not as boring as they used to be, and I will get to that in a minute, and mostly mid and large caps. And here we have about 300 million in AUMs, and here on the energy transition side, so here looking at the entire value chain, technology companies, equipment manufacturers. So here the companies that benefit and provide the tool set for those utilities to invest in. So essentially, as I just mentioned, it's almost 20 years that I'm in that space, and I must say, has been rarely as exciting as it has been and as it is as now. The main reason is that 20 years ago, when I started, renewables were far from competitive. The drive was there to become to have a sustainable energy landscape, but the renewables, etc., were still very, very expensive and subsidy dependent. And the time has really changed. The drive to sustainability has increased from a political landscape, from a political point of view, from a company point of view. Investors are realizing that it's going into that direction. But what has really changed is affordability point of view. We have really seen breakthrough technological innovation, huge scale increases, and so renewables or many other environmental technologies are now cost competitive or even the cheapest source in many areas of the world. And so therefore cost competitive with fossil fuel-based solutions. We've unfortunately had some major geopolitical events that made also those renewables and locally produced power being much more attractive in a certain sense than fossil fuel-based from not like-minded countries. We've seen that in the gas topic a few years back. But what has really changed, and this is really new now, is over the last 12 to 18 months, is that power demand growth has accelerated. We're coming out of 20 years of stabilization, of no growth, essentially, to now a new phase where we are having 5 to 6% in the US, and also in the Europe, we are going to see that acceleration in power demand growth. And that is combined and coming mainly from very deep-pocketed and power and companies that are doing a lot of, or creating a lot of value with that power, and that's among others also the hyperscalers and other big corporates. So I'm going to go through those now. Those two topics. The power demand growth. Here you see very well over the last 20 years you didn't have any power demand growth. Here we're in the US, stable at 4,000 terawatt hours, and now and these are not just some consultant expectations. These are really the numbers that the utilities are putting into their prospects and into their capital budget plans. So 5 to 6% was what we've expected only 9 months ago. We had to probably increase. We had to increase that expectation, and the main reason of that power demand growth is on one side, 1,400 terawatt hours, so about 30% increase coming from industrial electrification, e-mobility, heat pump, the whole climate adaptation, if you want, from HVAC, so air conditioners. But what is also driving, and here is the theme of data centers, with driving in the low AI scenario about 600 terawatt hours, and on a high AI scenario about 1,400 terawatt hours. So overall, 2 to 3 terawatt hours roughly that might be coming on top of the existing 4,000 terawatt hours. So we will be reaching growth levels that we haven't seen since the 60s or the 70s when we've installed the TVs and the fridges that we just installed the TVs and the fridges. So where is that coming from? Where those 2,000 to 3,000 terawatt hours are coming from? Here you see very well that energy transition until now has happened without any additional power demand growth. So you see coal has been replaced by gas and renewables. Industry didn't add any firm capacity since 2005. And just a little hint here, coal didn't do a comeback despite all the efforts of the White House administration during 2016 and 2020. So let's see, did that analysis here, assuming 5% power demand growth. Where is that coming from? So essentially, there are not many choices. You see here, first of all, the nuclear restarts. There is very limited coming. It's the very dark here, this part here. So it's only coming 28, 29, 20, and it's just a handful of nuclear power plants that can be restarted again. We have no new nuclear in that time frame, so whatever we would be deciding now will be coming in 2035 at the earliest. We will have some power demand that is coming from increasing the utilization rate of gas power plants, but here it's essentially also the peaker plants, which are not adapted for that, so that's going to be coming at a higher cost and higher price. And new natural gas power plants are only coming, and that's here in the red, only from the 28-29 time period. So essentially what you have is solar and wind are essentially your only solutions, combined with storage, of course. And that's obviously not only the cheapest source, especially also in the US. 12 to 18 months, very readily available projects if you're already in the interconnection queue, and so this is essentially your only solution. But what that means also is that what we see here, we will run into a power demand deficit, and that we see that has an impact already on the power prices. Power prices are, if you take the normal wholesale power prices, about $50, but we see that renewable power prices already get a premium because those big tech companies are entering large contracts, and so those power purchasing agreements for renewables are reaching higher prices already. We see that those big tech companies are now they see that it is getting tight. They're already now setting or going into contracts we've seen Amazon with Talon, we've seen Microsoft with Constellation, we've even seen the GSA, sorry, that's a US department, also going into a contract, 10-year contract, and this compared to the $50 US dollar wholesale price, they're going into those contracts for 93, so over a 60% premium, and that clearly tells you that those very smart buyers have a very strong view that power prices are going to go up. This means a lot of investments. The utilities are now responding to that, so they see those trends. Here we've done a lot of deep dive, so this is a big difference between a team like us and obviously if you just buy an ETF. Here we really go into the details. We've listed all the utilities and their capex plans, and we see that on average, capex plan to capex plan, they always go by 4 to 5 years. They have increased by 23%, so that means more solar, more wind, more storage, but also especially a lot more grid investments. And you see that in those plans here, you have 4.6% power demand growth, and we believe that this is even conservative. So here we see very clear that whatever comes out of the White House, of course, if he says drill, baby, drill, that's one thing, but essentially there is no other alternative than to go for all sources of energy, including renewables, solar power. Essentially, we will need all types of energy sources, and solar, wind plus storage is definitely the cheapest and the most readily available here. So let's go into the two funds. I will first talk about the Energy Transition Fund and then talk about the Infrastructure Fund. Here, as I mentioned, we're talking here about investing into the entire value chain. So from so this is the investment universe. So from the renewable energy production, we invest into the grid, all the grid equipment, cables, electrical equipment, the smart grid, power semiconductors, and also the whole energy efficiency topics in the industry. So how to produce more energy efficiently, green building, and new mobility. You see, the main reason why we invest across this whole energy landscape is if you want to become net zero, essentially it's coming 25% or 1/4 each from renewables, energy efficiency, and electrification, with about another 25% plus coming from those areas that are very hard to abate, industrial applications where we need hydrogen, CO2, carbon capture and storage, and also renewable-based CO2 removals. So here, but this is those ones are really the hardest to abate topics. So here, this is the performance. So what you see here, multiple things since 2016. You see on one side this first wave of the energy transition. You see very well also Trump 1.0. This was from here to here. So everything bad for the energy transition landscape. We actually see that with all the efforts that Biden did, unfortunately, didn't result in, actually rather resulted in a consolidation of the share price performance. What we see also that here the valuation is now as low as at the very low point of end of 2018, which we were in the middle of the trade war and Powell reining in the monetary policy. And what you also see is the outperformance of the fund versus a random or the biggest ETF on that landscape. So here a good phase of consolidation, and we see that this has also obviously been impacted partially by the whole negativity surrounded by Trump and his anti-renewables. But effectively, we are now at a phase where what I showed you before, that power demand growth is now really accelerating, and we see that in the fundamentals of the companies, and that should improve and provide a very interesting setup, and a few awards that we also received here. So here, just very quickly, performance versus the peers. I'm not going to go very long on that. Now, let's go through really the power demand growth and where that's coming from, really deep diving now into this AI and data center topic. You see here, once the most powerful GPU from NVIDIA 10 years ago. This was the Ivy Bridge, consuming 180 watts per about 180 watts per chip. We are now at 1.2 kilowatts, so effectively almost 10x for the most powerful GPU of NVIDIA. And that despite being much more energy efficient. So if you take the computing process per watt is much more energy efficient right now than at the time. If you put those GPUs and those chips into a standard server rack, we see that those high power server racks consumed at the time 14 kilowatts. We are now at 132 kilowatts with the latest Blackwell chip, so with the server with the current Blackwell chip. So, and the projections are here that by the end of the decade we will go for a standard rack, so 60 centimeters, 2 meters high, about a meter deep, that we will go to about 1 megawatt for one rack. So this is enormous amounts of power. This is enormous amounts of heat that is being generated. So you can't only just cool the whole data center efficiently anymore. You need to really cool the entire, going directly into the server and into the chip. So direct to chip liquid cooling is then the next phase of technology. So we see different technologies here in terms of cooling. It's you have to go really, really energy efficient. So liquid cooling is one of them. We're talking about PUE, so power usage effectiveness. Essentially, is the extra power that you need to cool and the whole data center infrastructure surrounding on top of the GPUs. And you see that the AI specialized and the hyperscalers are really leading here in terms of technology and bringing those PUEs to very close to one. That means not only extreme high levels of investments, not only on the power train, so you need to bring all that power, but you also need to extract all that heat. This is those GPUs emit a lot of heat. You can just think one of those, sorry, just going back here, one of those here, 132 kilowatt, just to put that into perspective, that's about 100 hair dryers that are lying next to each other, just to put that into perspective, and consuming a lot of the power at the same time. So putting that into perspective, the power, electrical equipment and power management side of it is growing at a 20% CAGR. The thermal management is growing even faster because it's not only you need to go much more technical and much more complex at a 39% CAGR, and especially driven also by the liquid cooling from obviously a much lower base, but here growing the fastest here. So you see, I just put you here to show you how visually how that looks like. You have the power train and the thermal chain of a data center. And this is a traditional data center, and this is a modern AI data center. So you see in the past you just had a few switches, switch gears, a few transformers. Here you have a whole set. It's almost a kind of a microgrid. You need renewables, you need battery, you need electrical power management systems. It's really critical. Those data centers need to be reliable, 99.999%. And same thing here on the cooling side. It's not only air for the whole data center, it's air and liquid and the entire data center and the server racks, etc. So it's getting really complex. You have companies that are very well positioned here, that have decent growth. They increase their forecast until 2029 to growing by 12 to 14%. The operating profit margin has also increased quite substantially, 25% now by 2029. They've already achieved 20% in the last quarter, and that's trading at a very attractive multiples. Here, very good quality companies that are really in a sweet spot of that trend. If you take a step back, in the end, we know it's all about the energy efficiency, and winning that energy efficiency race or that AI race will become key, and energy efficiency will become key in that race. So it's essentially all about reducing the power per computing operations. We have companies that are working to improve that relationship by 10,000 times over the next 15 years. So here, think about new manufacturing equipment on a semiconductor side, or electronic design, architecture, EDA. Here, all type of, or even just simulation for entire data centers. So think about here companies with very high quality investment, double-digit growth, 30% plus EBITDA margins, and very good free cash flow generation. If you go a step back now and see on how all that power will be delivered to those data centers or power stations or charging stations for electric vehicles or heat pumps, etc., etc. Essentially, we see that a lot of investments are going into the grid. Within Europe, we expect those to increase for those 4 big countries: Germany, UK, Italy, and Spain, going from 20 billion to 65, 72 billion investments per year, and that's really a massive investment. We see similar investments also in the US, because here, on top of all that power demand growth, we also have. Please sit down. Please take a seat. You don't want to sit here. And so what we see here is really an aging grid in the US, much older than the one you have in Europe. And on top of that, you need to integrate the renewables. You need to make sure that you don't have any blackouts. It's a big topic in the US because of the grid is so aging. And now you have all that power demand growth. So this is benefiting not only transmission cable companies, so NKT on the high voltage side. We have Siemens Energy doing transformer companies, transformers. We have other electrical companies like Eaton, Schneider, Prysmian. We have a lot of engineering firms that benefit, and all those companies have now very good visibility towards the end of the decade at very good pricing, very good margins. We're seeing a real supply crunch here in that sense. Labor is tight, equipment is tight, and with that, that is a very good outlook for those companies. We call it the best of two worlds approach. So we like to look at the big companies, but we also like at the very small companies. Here, this is a very small company from out of Switzerland, R&S Group. They're doing transformers, 740 million company. Here, definitely one of those companies that will benefit from the different infrastructure plans and grid capex in Europe. They've done a very accretive acquisition of a very similar company that is very complementary from a geographical point of view, also from a product company from a point of view. And here, 10 times PE for the next 24 months. This is a bargain, and the growth is definitely very strong for that. So here, very attractive investment. As I mentioned, also we look at bigger companies. Siemens Energy is here, definitely the leader in the grid space, but also in the gas turbines, and obviously had a few issues on the wind turbine side, but this is from a valuation point of view just a very small part of the entire enterprise value. So here again, really on a long-term perspective, a very attractive valuation, and a company that is growing in a double-digit way. So I mentioned some of the grid investments. Also here, the cable companies. I mean, just to give you an example, the backlog of those companies over the last 5 years are increased almost 8-fold. So that means visibility until 2030, 2031, 2032. Companies like Prysmian, NKT, and Nexans are really benefiting from that trend, and that means better pricing power, margin expansion, and strong free cash flow generation. We have a few investments in the renewable side as well. We keep our money back for the moment because you have that news flow, and because you have that short-term insecurity on the Inflation Reduction Act in the US. But we are really in the starting blocks to put that money back to work once that noise and that news flow is out, because we are really convinced that renewables, solar and wind, are really on the short term the only way to go for the US. And also and by the way, it's very much backed by the individual states. Also in Europe, you have a strong backup here because it is essentially the cheapest way to produce power. So this is the portfolio, very quickly, very diversified across the different sub-themes. Also from a market cap point of view, we are roughly half-half Europe, US, a little bit of Asia, not too much. From a MSCI World point of view, industrials, then IT, and a bit of utilities and materials as well, some consumer discretionary. So here, just a quick view on the top 10s. You see those names. I can go through them, but they are really all very attractively valued. I mean, Prysmian close to 12 times, Vertiv 17 times, RNS 10 times, Schneider is now below 10, Linde a bit higher, just above 20, but here SPIE 10 times, Kingspan 15 times. So very, very attractive setup here, and not at all the high valuation that we would have had in the space 3-4 years back. So if I put it all together just for this fund, really those energy transition stars are aligning. We see very strong investments into all that power demand equipment, that HVAC, that cooling equipment for the data centers, but also the building and building efficiency in general. Very strong investment in power grids and very attractive valuation short term, because you have some of that negativity in there and some of the short term noise and impact from what we have coming out of the White House. But the portfolio is much higher quality now, very good companies with very good free cash flow profitability and very good company modes. Let me move to the energy infrastructure funds, which this one is, as I mentioned before, 100% utilities. So these are the companies that are operating that, so very good visibility. This is probably one of the longest track records in the industry that you will find, about 9% CAGR annualized, a very strong outperformance over MSCI World since launch. Performance almost as good. I mean, you see sometimes it's ahead, sometimes it's just below MSCI World, but this at a much lower volatility, very good diversification from your normal, most likely US tech weighted portfolio, many awards. So this is a very strong performance from my dear colleague Andreas. And here you have the key metrics here, 9% CAGR, as I mentioned. MSCI World was at 8%, and you see a correlation, the lowest that you can find versus MSCI World, so very good contribution to your general portfolio, and valuation extremely attractive at 3.2% dividend yield. And as I mentioned, those 9% happened during the 20%, so the 0% power demand growth. So those utilities are now accelerating in terms of power demand growth, and the portfolio is here again also a bit more tilted towards the US and about 45% Europe. So let me go through the three big buckets. I mentioned before, we have a whole bucket in which are the US regulated utilities. I showed that slide before. It's about 46% of the fund. Those companies have a very strong visibility on growth, investing a lot into renewables, but also in the grid. They're regulated. There's no risk of tariffs or whatsoever on those companies, and they see a very strong accelerating power demand growth. Here, this is just a very good example on seeing those EPS growth that you see, 8% for those companies that we have here in the portfolio. So really all the opposite of the power of the boring utilities that you would have expected and have in mind with maybe 1 or 2% growth in the past. Valuation of those companies, so you have the utilities versus the S&P 500, are trading now at 20% discount to the S&P, and this while they used to trade at a 10% premium, so you have about 30% discount to the usual run rate. And what you see here is that this came after a period of underperformance, similar to what we've had here in 1979 when the 3 Mile Island nuclear reactor exploded in the 80s, or just before the dot-com bubble burst. So we have a very similar underperformance versus MSCI World, and this is, in our view, very likely to reverse because the fundamentals are improving quite substantially. Here, just an example on the US generator. So we have the companies that are not regulated. Here they benefit obviously from that tightness in the market that we've seen before. Prices are going higher, and those companies that have spare capacity can clearly improve and benefit a lot from those power prices. And here, the companies that have suffered quite a bit last year, the renewable exposed names, I mentioned why, the negativity around them, but you see also where those multiples are, and we see them stabilizing. So an AES at 5 times, RWE at 10, SSC at 8 times, EDPR at 16, and Northern Power at 8 times. So here, a very attractive element and very attractive valuation for those companies. And we see that those companies are now stabilizing a bit, and the growth is continue to be very strong. So, and why is that? Because we see those big corporates doing deals with those firms here, the AES and RWEs of the world and the EDPRs. Just one example, Microsoft last year did a deal of 10.5 gigawatt with Brookfield. So this is more or less equivalent to 100 billion of data center investments. So here, and that's also for low carbon power. So to conclude on that fund, we really have a step change here in power demand growth. The utilities are accelerating. They are not the boring utilities anymore. The fund has generated 9% performance during the time where there was no power demand growth. So here we see, actually, combined with that low valuation, a very attractive setup on that accelerated growth, because the power generators are going to benefit from better pricing and better margins. And so here, this is it. This is the portfolio, very attractively valued, as you see. And these are the person to contact. And you have Holger Höpfner. So if you have any questions, I'm very happy to answer them.
All the companies in your portfolio are publicly quoted, or are they
Yes.
also private companies?
Yes, you can. They're both. There are two of them. So the infrastructure fund exists in a Swiss-based fund and as a Luxembourg fund, and the energy transition fund is a Swiss-based fund. But they are both publicly quoted. You can buy them.
But I mean your investments.
The investments.
So
sorry, misunderstood. 100% listed. Yeah,
100%
long only.
listed.
Listed equities.
Right. I have an. Yes,
Yes.
and I have other question is like the prices you gave for the PPAs of 90 or so, are they base load or are they solar cured?
So that was for solar and renewables, exactly. Yes. So
Well,
solar
no.
or wind, but that was not base load.
Not base
Yeah.
load.
For base load, that would be probably higher, exactly. So if you would add combined with a battery, for example, you would have that. It would be a bit higher, but still, actually, gas. If you compare that to real base load and new base load, new nuclear is actually quite expensive. Also, new gas, the gas price, the prices of new gas turbines has increased quite a lot. So we are talking about renewables being really one of the cheapest sources out there. Yeah.
Yes. I have another one.
No, go ahead. I mean,
I
think
really like the topic.
if you're
So do you have investments or any of the funds directly also into infrastructure, or only through companies operating this infrastructure?
The companies are investing in the infrastructure, so they are having operating the grids, operating the power plants, operating the renewable farms. That's what that we're doing, but we don't invest directly in the projects.
All right, thank you.
Further questions, please? Expectations are high. Please comment.
Yeah, I was hoping to get a bit more insight on the real estate side.
Yeah.
Comments on the real estate side, please.
Yes, no, I mean, we don't invest into real estate. I mean, I used to invest into the kind of Equinix and digital realty type of companies on the data center side, because they are, I mean, just taking an Equinix. We're not invested currently, but an Equinix, for example, would be one of the operators of those data centers. They are co-location, so it is one of the more energy efficient ways of of operating servers, if you want, because it's not just a server in the building here that emits a lot of energy, etc. It's like really lots of clients together, and obviously the top systems and everything. So from an energy efficiency point of view, they are really very well positioned. Also, they compensate the power that they get from the grid with renewable energy grids, buying PPAs, as I just mentioned. So that would be the type of investment that we could do, but currently we don't. So yeah, that's good. Please.
Do you have any interest into a Swiss company? Because there is a public, right? So do you have any investments into a Swiss company?
Yes.
Like in the sector?
Yes, well, I mentioned the RNS Group, which is the Swiss company invested manufacturing transformers in Sissach, Basel. We visited them. It's quite an interesting factory as well to visit. So yeah, that would be an investment that we do.
All right. Thank you.
So further questions? Boys?
Do you see any pressure from future small-scale nuclear reactors coming up in the future?
Good question, and it's an interesting topic because 3 weeks ago, we were at the Paul Scherrer Institute to go exactly to follow that topic, and I can reassure you we are still far away from that topic, just as far as we are from a normal nuclear reactor. I mean, we're still in the pilot stage for that essentially. So whatever we would decide now, it's from 2035 or more or later. So there's a lot of talking about it, but until we reach that point, it will take quite a bit of time. So until now, it's renewables, solar, wind, batteries, and complemented with gas. Natural gas will be definitely seeing a revival here.
But sorry to interrupt, but that contradicts a bit to the to some of the statements that were made last year at the SECA conference, which was all about like alternative energy generation and also nuclear. And
Yeah.
they were presented a couple of startups based in Canada and the US.
Yeah.
Predominantly not in Europe. And that seemed to be pretty advanced stuff. I mean, not like decades away, but maybe just a couple of years away.
No.
Like ship container
Yeah.
size reactors.
Yeah, no. They're testing. Yes, they are testing. So we had the head of the one of the departments. They just had they were planning about doing a molten salt reactor, and yeah, it's a startup out of Denmark that cannot do it in Denmark because the regulation is not there. The regulation is here, but also here it takes time, and yeah, so here they will build it up. It's a 1 megawatt piece, and yeah, they will test it for a couple of years, and then maybe at some point then they will have to file for the real one, and so we don't see it before 2035 really at scale, especially because I mean these you need to design it, you need to build it as a pilot. You know, we don't have any, there's no pilot project yet, right? So even for the pilot project, no. It takes, it will take, might come, but then also from a cost point of view, I don't think it's will be so much as cheap as people believe they will be.
I understand, but in a country like Switzerland, where you just, I mean, where the ground is so valuable, where you just cannot have like hectares of photovoltaic placed just anywhere, because like I understand, like a normal data center, they need like 40 to 80 megawatt, and AI data center, which is part of the title.
Yeah.
1 gigawatt. I mean,
Yeah.
you would need like enormous space amount, and the energy density
Yeah.
is just so high. So
That's why, I mean, Draghi put it very clearly. I think the key element of the competitivity of Europe will be a very good energy system, meaning especially the grid, interconnections within the different countries in Europe, from bringing the wind power from north to south. But yes, and there will be, and every country will have its speciality, right? Obviously, wind and solar is not going to be the one that will deliver the power in Switzerland. We have hydro, but and
during his keynote speech at MIPIM this year, which is the biggest real estate fair in Europe, he did the keynote and he also specifically mentioned nuclear.
Yeah, but It's next decade. Yes. I mean, nuclear is because essentially those data centers are essentially negative nuclear power plants because they draw so much power and they need space load and everything, right? So yes, nuclear. Yes, one day we might come back to that. We might see, but have a look at Hinkley Point. I mean. The beginning of the decision was the decision of the process of building that nuclear power plant started in the early 2000s. I think the decision started in 2008. Was supposed to be 2010. Was supposed to be finished by 2025, and now it's probably going to be 2032 that it's going to be finished, and at double the cost, 40 billion instead of 18 expected. So just to give you an example of. We haven't built cheap power plants, nuclear power plants, for a very, very long time. Even the Vogtle power plants in the US were way above budget and way beyond time. So it's taking time. It's unfortunately, we have obviously higher regulations, which is good and bad, right? But obviously we don't churn out one new nuclear power plant like China or India or any one of those countries. So yes, we might go back there, but it will take time, and it's definitely not a solution for the next 5 years, which is probably the investment horizon that probably any of us has. So.
One more question, and then we should break up. Our time is over here. So the next presentation start.
Yeah.
So you were mentioning that the renewable energies, they are the cheapest solution, the short term. And I wanted to know if you have any insights about what the government policies they are going to be in the future to follow this path, or the government, they're always changing. It's difficult to answer this question, but do you have also a view on this side?
Yeah, it obviously depends country by country, right? But what we have is, just to give you one example, I mean, we had, and maybe just back, if you remember this, Energy Stars translating, right? So it's more about economics and much less about subsidies. I mentioned that 10 years ago, it was a lot about subsidies and less about economics because, economics, but post-subsidies. So what you have now is that more and more this is driven by economics and more driven by business needs. So that's point number one. Then you have the whole permitting aspect, and that was a big bottleneck in like even 5 years ago in Europe. With the invasion of Ukraine, what we had is that we had this European-wide policy called Repower EU, and that was not driving new subsidies to the space. That was essentially just trying to facilitate and simplify the permitting process, and we've seen that in Germany it was extremely successful. I mean, we're all bashing about Germany, but this is was a very successful change in regulation. The wind market went from 1.5 gigawatt auction run rate to 8, almost 10 for 1 or 2 quarters now already. So we see that this has really, we have debottlenecked the process. We are seeing a lot of new wind installations. Same thing has now been approved also in France and Spain, so we see those markets opening up. So essentially we're quite positive for the European side, and if you look at last year, the US, we've installed 50 gigawatts of solar, which was record high levels. And yes, maybe short term we might have some insecurity about what is going to be, Inflation Reduction Act, is that staying or not, etc., etc. But effectively, even if the Inflation Reduction Act, which is a 2-3 cents helper for the price of solar and wind, if that goes away, essentially that means nothing else. That this will be being pushed to those power purchasing prices. If you build less, then that supply-demand deficit that we have will be even bigger. So that power prices will go up, and that will be compensated. That will compensate the lack of subsidies, assuming that everything goes away, which we don't believe because it's a bipartisan support in a certain sense. You have a number of Republicans that have written to the administration that they want to keep big parts of solar and wind support because that money goes into the red states.
I need to interrupt. I think we need to very much for the attention. Very much looking forward to meeting you somewhere else. And the
Thank you very much.
installation side. Keep it.
Thank you very much for your attention. Thank you. Thank you. Bye-bye.